what happens is if you start like practicing those anti-patterns and you have them in your company, it's death by a thousand cuts. Eventually your company is going to go, right? Sometimes faster, sometimes slower. But basically what I'm saying is, I think the best way, especially for folks like you and me, who are doing a lot of smaller checks at the earlier stage, we don't really know who the winner is going to be. Like anybody at the stage that we invested that's going to tell you, I know how to like pick winners is bullshitting. Or they're lying to themselves. It's not true. We don't know who's going to be.
No.
What we do know is who's doing stupid stuff that's probably not going to work, right? So the pattern recognition is actually a failure, not a success.
I love that. I love that. Yeah. I mean, it's a nice way of framing it. And it crystallizes sort of my easy yes, easy no framework. Because you see stuff and it's like, that's an easy no. I've seen that before and it has some sort of yellow, red flag or some combination of those that I just don't think it's going to work. Part is getting down to that last like 5, 3, 2%, that top 5% and saying yes to like one. Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Itamar Novick, founder and general partner at Recursive Ventures. He has over a decade of experience investing in early stage technology companies, backed more than 100 startups. Interesting. Including multiple unicorns like Life360, where he bought out the co-founder. Ooh, interesting. Deal, Placer.ai, or some others. He's been recognized as a top 100 global seed investor by Business Insider for 4 consecutive years. Beyond investing, Itamar has a rich history as an entrepreneur, having held key leadership roles at Life360 and Gigya, among others. Welcome to the program. Thanks for coming on.
Ryan, thanks for having me. Excited to be here today.
So maybe you could walk us through, start kind of from the beginning. What inspired your journey into VC after, all your time as an entrepreneur?
Yeah, absolutely. So first of all, I've been in startups for 25 years and I've been on all sides of the table, right? I'm a repeat entrepreneur and a startup executive. I've been doing institutional VC investing, seed investing. I actually even put together an incubator called UpWest back in the day. So I've really been on all sides of the table. To make this a little bit more interesting, what I've realized over the years, like working in the startup sort of entrepreneurial ecosystem for 20 plus years, is that I'm not a great CEO, but I'm great at supporting CEOs. And that's how, that's an easy segue into becoming a VC, right? So that's kind of where I landed, the way I landed.
That's so funny. That's exactly what I tell my LPs and my founders and stuff. I'm just like, I'm not generally good at any of the things, but I generally know a little bit about all the things. I think it makes me a better investor than an operator.
Yeah, I guess so. And also like it's really what you love doing day to day. If you love being, heads down and not necessarily meeting people and just working and building the best product for many, many years and that kind of thing, that's great. You should be a founder. But I think you, like me, you've got a little bit of ADHD. You like jumping around from different projects, different challenges, meeting different people, right? Networking, getting out there. So I think folks that have that sort of tendency, they end up doing better as VCs than entrepreneurs.
Yeah, I should probably take an ADHD test and see if I have it. I'm pretty sure I do. But although I like to focus too, right? I like to kind of just dive deep and spend an hour or two on things, but I lose interest really fast after 6, 12, 18 months on a project. And I literally need to move on. I need to and I job hopped a lot, throughout my career because I'd be like sick of things.
Yeah. And that leads me to think about my partner, Chris Holz, who's the CEO founder of Life360 and has been running the company since 2007. Yes, that's 18 years. So you got to have that maniacal focus of almost blind yourself, just focus on, I'm building the number one company in the family safety and peace of mind space. And I don't care about anything else. Don't come to me with any sort of defocusing, pie in the sky, shiny objects. No, we're just building this and being heads down and doing that for 18 years. That's not something that, anybody can do.
Yeah. We're recent customers of Life360. So tell them thanks for that. It gives us a lot of peace of mind as parents. We have 3 kids, 14, 12, and 8. And just gives us a lot of, where are the kids? Because they're out roaming now. They're teenagers. And even my 8-year-old daughter, you're even doubly scared of your daughter, right? Wandering off and getting snatched up or whatever,
Well, first of all, thank you for being a loyal customer of Life360. I hope we can convert you to the paid plan as well, which is,
I think we're paid.
Very worthwhile.
I think we're paid. I'm pretty sure. Yeah.
So the thing with Life360 is it's true freemium in the sense that you can get a lot of value from the system without paying. And that's totally fine. When the extra features that you get when you're paying are really life-saving features. And not a lot of people talk about it. Even Chris, I keep telling him, it's like, Chris, why are you not talking more about this? But There's one feature that we launched that is the crash detection and response feature, where if somebody is in the family is involved in a car crash, we actually know the severity of that crash. We literally know that you've been going 60 miles per hour, and then you got hit, and then you got dragged for like 30 yards, and we can kind of
Wow.
figure out how bad this thing was. And then if you don't pick up the phone, the call center, I'm actually the guy that set it up, sends over an ambulance right to the exact spot where the car crash is. And that is a life-saving feature. Like Life360 all hands meetings start, Monday or Tuesday morning, whenever they have the all hands, start with like testimonials from users, like real world users who are like, you saved my life. Thank you. And that is so inspiring, right? For the team, and also just like a great product when, a lot of tech companies are building like, the best game or the best, mousetrap for whatnot. Life360 is actually out there saving lives.
Yeah, that's amazing. So tell us about your kind of background. Were you an early investor? Were you an employee at some point at Life360? Tell us your kind of connection to that company, besides
Oh yeah.
having your partner. Yeah.
So I was a VC on Sand Hill Road at a firm called Morgan Ventures. When one of the GPs this is 2010, one of the GPs at the firm was an early angel investor at Life360, basically brought the team to do a seed round. And I did all the diligence. And we passed on the deal. So did everybody on Sand Hill.
So you guys passed initially. You passed on the deal, you said?
Oh yeah, the firm passed on the deal, but I did all the diligence. I was a
Okay.
senior associate. I was a junior guy, right?
Yeah.
Worked with the partners. This is 15 years ago. But I did the diligence, and I was like, wow, like there's something here. Like consumers want this, and I'm not sure the VCs are getting this. And then we were like, we came to a partners meeting, and one of the GPs, I won't name the guy. He's an amazing guy. Was like, I don't think we should do this deal because kids are never going to have smartphones. Like, what? Mind blown. Everybody's going to have smartphones. Like in the back of my head.
So that was his thesis. That was the risk in his mind. Is like, these smartphones are really expensive. I don't think parents are going to allow their kids to have these unfettered access to the internet or whatever.
Yeah, it was like a business tool back then in 2010. Nobody thought that everybody's going to have this device in their pocket that's like always connected. And so we passed on the deal, but I saw the numbers. I did the diligence, like, wow, there's something here.
What were the numbers? Do you recall kind of those early numbers in a consumer device where you're like, wow, this is taking off and going to the moon, and we should probably hitch our wagon to the star a little bit?
It was like mobile, like the app stores were really early back then. So there was a mix of web, and there were tens of thousands of new registrations a month, right? It was in the tens of thousands. And it was,
which is crazy. So their acquisition cost is like nothing.
Well, even today, Life360 has millions of monthly downloads with zero spend today.
Wow.
The word of mouth on this product and the App Store optimization.
Parents talk, right? I think that's how we found out about it. Parents are like, yeah, don't you have your kids on Life360? Like, oh, yeah, no. Do you even care about your kids, bro?
Exactly.
No,
right? There's some guilt associated with that. It's like, oh, are you a good parent? Are you actually like making sure that your kids are A-okay, like you should? But no, but also like ASO and a bunch of other things that we did. So Life360 is actually like a social network, is one of the fastest growing, like amazing success stories on customer acquisition in the consumer space with very little to no spend. And still today, like their marketing spend is ridiculous. It's a public company. You can check it out. It's like I don't want to quote a number because how this works in public companies, but it's a freaking joke how much they spend on marketing, and it's all organic, right? And the reason is because it's a great product and people talk about it, and there's word of mouth, right?
Oh, it's a $5 million company, so that's a pretty good outcome.
Oh, the market cap?
Yeah, the market cap. Yeah.
Yeah, it's a $3.5 billion market cap.
Yeah, $5 billion Australian dollars.
Well, it's NASDAQ traded now.
Oh wow.
We listed in the NASDAQ in 2024, like 8 months ago, and that has helped a lot with the share price. So it's traded in the US now in the NASDAQ, $3 to $4 billion market.
That's amazing.
Rightfully so. Anyway, so I saw the company and everybody passed in the deal, and I was like, okay, I'll just.
But your instincts back then, as a senior associate, was like, hey, we should have like they are. And what else about the deal? So besides the metrics, in hindsight, were you like, how did I guess the question I'm asking is like, how did it change your approach to investing? What are some lessons learned there? Because that's kind of like a miss, right?
I think, yeah, there's a good lesson there about Chris Hulse specifically, the CEO founder. So when he started this company as an undergrad at Berkeley. So he had zero real world experience. He did like one summer internship at Goldman. So no, like he's not a tech guy. He's not an engineer. He hasn't built anything, right? And he started this company. So obviously all the VCs were looking down at him and saying, yeah, we have execution risk here. Like, we don't know if you can build this stuff, right? And my lesson learned is specifically on founders would with Life360 was there are people out there. I mean, this guy Chris Halls, he's like Mark Zuckerberg, who's like just so smart, just so capable, and more than anything, can learn on the fly. So he will learn how to build this tech. He will learn how to bring the right people. He will learn how to manage them. And that's what Chris did over the years. And sometimes you just have to believe in people and find ways to figure out if they're good enough to take this from A to Z, even though they don't have that track record yet.
I
And
think
that's
just to be an undergrad and take it to where he got it, like you got to be sitting there in 2010 going, wow, that's really impressive. You created something out of nothing as an undergrad and you've taken it this far.
and
Just that
10
alone
years.
at 21, 22 years old is really impressive.
And he's still the CEO, co-founder on a completely different company than what I was in 2010. So anyway, so I was super impressed by him. He's honestly the smartest person I've ever met, and with a great product sense and just also great interpersonal skills. And I think the VCs were like, yeah, sure. I mean, there's a lot of smart kids out there, but like they didn't really think through on whether this kid can go all the way. And I figured out that he can. So anyway, fast forward, I didn't do the deal, kept being a VC, and then I figured out that I need to leave venture because it was very clear to me that I won't be able to operate as like one of the best GPs in the world if I don't build a big company. So I left and I decided that the best bet I can make is going to Life360, but not just go into the company. I was there as an employee, by the way, for 12 and a half years. Not just go as an employee into the company, but actually I had an opportunity to buy out a co-founder that wanted to leave. So I took every single cent that I had at that time. There was a co-founder that wanted to leave. His wife convinced him that he needs to sell all this stupid startup shares. Like, who
Oh
cares about it?
no.
It's worthless.
Oh,
And bought the guy out at the $6 million post-money valuation, just to give you a
nice.
sense of where things are at.
Probably happy, right? Because he had, 50% of the company or 25% of the company, whatever it was.
Well, much less. He was
Yeah.
already diluted because he was a co-founder that left.
Okay. So he didn't invest all the way. So he had 5 or 10%. You're like, cool, I'll take that 5 or 10% off your hands.
Every single cent that I had under my name, I actually even borrowed money.
Wow.
So went then all in on the company, joined the company. I was the VP, the first VP of product. Took the company from from zero to a couple of hundreds of thousands, maybe to like 10 plus million MAUs. Launched our first paid product. Then I switched over to the business side. I was COO for a while. I ended up being CFO for the listing. Took it public. CFO, chief business, corporate development. Did all the acquisitions, including Tile and so on and so forth. I really enjoyed Chris on the journey. Now I'm actually, as of the end of this year, I'm no longer a Life360, in the last year, I'm no longer a Life360 employee. But, I spent 12 and a half years scaling up this thing.
That's amazing.
And now
You
Chris
literally bet your
is
future.
also working with me on my venture fund. So we've been in this together for a while.
That's amazing. So you met this amazing kid. The partners didn't get it. And you're like, you know what? I get it. And I'm going to go bet my career on this opportunity, bet every cent to my name.
Yeah. And the funny
That's
story
so
is,
cool.
my mother-in-law, I'm originally from Israel. My mother-in-law was visiting from Israel, and it's like, what the hell are you doing with all your money? Like like my daughter's money, you're taking all of that, and you're going into this like crazy, risky, high risk startup. And I told her, look, like once in your life, you
Yeah.
gotta swing for the fences. Like you gotta make a big bet, go all in.
I love that.
And guess what? I'm a VC on Sand Hill Road. If it fails,
Yeah,
right?
just go back to be, and you got a great story. Yeah, you could go back as probably a partner after that experience.
Right.
Leave a senior associate, go risk everything. Tell that story to any VC. They'll like, I'm impressed. And you could like a year or two later go back, probably be a principal or partner, VP, whatever. But it obviously worked out. You got it at a 6 cap, and it's now a 500x outcome.
And along the way, I told VCs that I don't want to join them, but that's a different conversation that we should have later on because I'm reimagining venture capital the way I think it should be. Should have been imagined for me when I, as a late founder of Life360, raised over $400 million, and everybody on Sand Hill turned me down for 3 years, 4 years in the beginning. After I joined the company, I was in charge of fundraising. And man, I went to all my buddies on Sand Hill, and everybody like, no, 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 no. I still have a list of like 100 venture firms who like turned us down, and I keep calling them up from time to time. It's like, hey, should we be in your anti-portfolio now? Is that is an IPO at a $3.45 billion market cap count as anti-portfolio? So,
yeah, that's amazing. What a cool story. So, and consumer SaaS is tough, right? It's not for every VC. And so a lot will just kind of go, it's not going to work out. It's consumer SaaS. Yeah, you got some good metrics, but I don't think there's a big market there. Yeah, blah, blah, blah. And like, Do you recall all the reasons over those ensuing years, 3 or 4 years, that they turned you down?
Oh, so many reasons. So many reasons. So initially it was like kids are never going to have smartphones. Okay. Check that. That
Okay.
obviously we moved on.
Remove that risk. Okay. Yep.
Then, there's something about Life360 that, especially early on, creeped people out. Like, oh, it's this tracking thing, location sharing, privacy, all those things. I think, again, VCs there kind of, I don't expect them to have the crystal ball, but there was a writing on the wall. Even Zuck said, like Mark Zuckerberg said, privacy on the internet is dead. Consumers understand that they're doing a deal with these service providers, these companies are like, we're going to give you free services and we're going to do advertising or we're going to do data. Like consumers understand that and they might not love it, but they still choose to use, something like Life360, which again, you can get a lot of value of for free. It works really well for free, right? So privacy and kind of creepiness factor was there early on. Again, people didn't believe in Chris. He was like, who's this kid? He never worked at a tech company. He's not an engineer. He's not like, so I was sort of the adult supervision that came from the industry that was supposed to like give them confidence that we're going to build stuff. And then, we also, I think I launched the first Life360. I was still heading product paid sort of subscription plan around 2015. And before that, it was really just an audience play. We're growing fast, right? But we didn't have enough proof of monetization. And back then with consumer VCs, it was like, okay, like we went through cycles, right? The previous cycle is like, okay, if you have the audience, you're going to make money. Now we don't believe in that anymore in 2014, 13. It's like, you got to show us that you can make money. So they passed because we didn't have enough monetization indications. Those were the three main reasons back in the beginning. Later, there are more reasons, but that's like later stage, pre-IPO, post-IPO kind of conversation.
I'd love to like kind of dig into this experience and how it kind of shaped your approach to investing. And you kind of teased out, which I want to draw the string on, which is changing how venture capital is done. Like maybe you could talk a little bit about that.
Yeah, sure. I mean, lots of different interesting questions there. So this is going to be a fun conversation. So look, I'm a solo capitalist by choice, right? Solo GP, but at least currently I'm a solo capitalist, which means there's nobody else on the investing team. I do have venture partners and venture advisors, but they're not, making calls.
Yeah, you're the solo decision maker on the investment. Yeah,
I am.
And effectively, I'm the same at Team Ignite. Like I have lots of inputs, but I make the decision.
Yeah, so let's talk about, like, I believe that you and I are going to win, and I'll tell you why. Because I actually come from institutional venture, and I've went through this, and I know that in institutional venture, when you have that kind of Monday partners meeting, morning meeting, all that
investment committee meeting, whatever. Yep.
Yeah, there's a lot of sort of politics and bias, and process, and in many ways that
groupthink
leads to bad decisions and groupthink. And on one end, there is the, oh my gosh, like this partner should my previous deal, so now I'm gonna like should their deal and all that politics.
You get this back office like, hey, I'm gonna go support your deal if you support mine. You get this whole organizational problem of groupthink and bias, and also like saving face too. A lot of people want to save face in political situations. They don't want to look like they don't want to put their neck out and look like an idiot, right? I remember this at Microsoft and Amazon when I was working in big tech, in a management context. Like it's really risky career-wise and in your social standing with your peers to like speak your mind freely and be vulnerable, right?
Yeah, and we'll get more to that as we talk about supporting companies, because that also changes how venture firms engage with portfolio companies. But yes, so there's all this politics, and then you also have these situations, especially at the pre-seed and seed, when you're really betting on a team, an idea, where you have, like, let's say a consumer VC or consumer GP as part of an investment team that's voting, shooting down an enterprise deal. Like, why? They don't have the backdrop. They don't know this space. They don't know what's good. They don't have calibration around what's good and what's not. Maybe they could advise, but why are they voting? Why are they shooting down this deal, right? So you really get to, so this dynamic.
Lowest common denominator thinking, decision making.
Exactly. So there is that. And then when it actually gets to supporting these super early stage, like pre-seed stage founders getting their company off the ground, like getting from 0 to 1, most venture firms don't actually have the right mindset for that as well. Because I'll give you an example, right? So if a founder calls me up, this pre-seed seed stage company, and tells me, Itamar, we're going to pivot, I'm dancing on rooftops now, because that means that they've went to market, they've figured something out, they made a tough call of like, okay, we're no longer standing for X, we're going to stand for Y. Like, I'm talking about serious people, it's not just like fine, right? And that's a good thing, because they've actually learned something and they're improving. If you're a GP in an established venture fund, and in your company that you like convinced your fellow GPs and reported to LPs and all that stuff is pivoting, you are freaking out because now you have to go and change all your blue books, and you have to show up on the Monday morning partners meeting and say, guys, we were wrong. This idea, it doesn't work. We actually need to do that instead. It's like, and everybody's freaking out. And that's not what founders need. That's not what companies need. They need an investor that understands what it means to get a company off the ground in those stages, which means frequent changes, changing the direction, changing the ICP, like, right? And again, bigger VC firms they're not set up for that.
Well, yeah, I mean, part of it is, they wrote the deal memo, they convinced their partners to vote yes, and they're sitting on the board, perhaps, if they're a large firm and they lead. And it's a saving face mechanism. Now I look like I made a mistake.
Exactly. Now, let me connect that to a different piece that ties it all together and actually explains why I'm a solo capitalist solo G. Oh, wait. So, one cardinal sin, and I know I'm using the extreme wording here in venture capital, is trying to touch multiple micro asset classes at the same time. Let me explain. First of all, venture capital is one financial asset class, right? But it's actually composed of 3 micro asset classes that are very different from each other. Pre-seed and seed, which is kind of one micro asset class.
What you might call like pre-series A or early stage.
Yeah, where you're really betting on the unknown, right? It's like, we'll talk about the characteristics, but like that's one micro asset class, pre-seed and seed, pre-A, let's call it. Another one is early stage, which is like A, B, sometimes C rounds, right? And then there's obviously growth, pre-IPO, venture capital.
Late stage. So generally there's early, mid, and late.
That's a great way to.
Yeah. Mid is like your ABC, and then your late's your D plus kind of pre-IPO stuff.
Correct. And what I'm going to assert here is that each one of those micro asset classes requires different GPs, or at least a different GP mindset, right? Different portfolio construction, right? And different operational cadence, right? And what happens is when you try to mix those different micro asset classes into one fund, that's when performance starts derailing. With the exception of, I don't know, the Andreessen Horowitz and the General Catalyst of the world that hire hundreds of people that run each one of these in a silo and are best at X, and then they have another team that's best at Y, and they can silo it and operate it. But if within a single venture fund, you're trying to do both A's and B's and seed and pre-seed, and you've got different partners running around trying to do all those different things, if you try to fit them all under one roof in one process, I think you're bound to fail, with exceptions, right? And so, especially as an emerging manager, you have to focus. And let's say you decide to focus on pre-seed and seed, which is where I'm at. There's only so much capital you could deploy. Let's say $50 million pre-seed funds, right? If you're solo, if you're 2, then you can increase that and so on and so forth. But at some point, the model breaks. And what happens is the entire venture community, NLP community, is all geared for this one thing, which is growing your AUM. And so those are 2 things pulling in the opposite directions. On one hand, you know that in order to win, you got to be focused on stage. You need to stick to one micro asset class. You can only deploy so much. But on the flip side, you need more AUM.
Yeah. You're kind of like, there's like this curse of success, right? After the 3rd or 4th, 5th fund, where you've had some really good DPI, TVPI, and you're kind of now, you have more money getting thrown at you than you can properly deploy with what got you there in the first place.
And everybody's pushing you to get big. But when you get big, your model breaks and performance goes down. So what I've done, and this is controversial, is I've been very clear on, I'm not playing the AUM game. I don't care about the AUM gain. My funds are going to remain small from now until the end of eternity, as long as I'm running them, right? And to keep them small, it also makes sense to have just one GP. And we're going to stay focused, and we're going to be the best, pre-seed AI fund in Silicon Valley. That's what we're doing. That's what I'm doing, right? And while others are chasing AUM and pitching LPs to 100 and 200 and $300 million fund, I'm like, okay, good luck to you guys, because I think I'm going to beat you at the pre-seed with an AI focus any day when you're playing that AUM.
Small is beautiful in venture capital. It's very much a cottage industry, I think is what you're describing. So maybe you could talk about kind of like your fund structure, how big they are, how many checks you want to write, your check size, your follow-on strategy, all that stuff. Some of those fun mechanics.
Sure. So I haven't announced it yet, but I will in the next few weeks. But we've closed a Recursive Ventures 3, which is a $30 million fund focused on pre-seed and seed, write $500,000 to $1 million checks, 30, 35 companies in the portfolio. That's kind of portfolio construction. We put a little bit on the sides for reserves, but really how the kind of the fund is structured is we use the 30 million. I should say I use the 30 million to find out these companies, right? To plant the first seed, get going with the founders, see if we can get them from 0 to 1, get them some initial traction, right? Then if the company is really scaling well, then I put together syndicates. And those could be multi-million-dollar syndicates to keep backing those companies in subsequent funding rounds. So it's a $30 million like fund to find the companies. And then
first checks.
With syndicates. And when you're scaling up with syndicates, it's not like scaling up AUMs in a fund, because when you raise a fund, you have to deploy the capital. I don't deploy the syndicates unless I believe that we should do this deal, right? So it's a deal by deal basis, not because I can't pull an opportunity fund together or raise a bigger fund. I can, but because I believe that it screws up your discipline if you do that, right? It forces you to invest, even if it's not the best deal out there. And my commitment to my LPs is we're going to invest in the best deals out there. We're not going to invest for the sake of investing. We're going to invest because this is a great company. We're going to make money.
Yeah, that's interesting. So maybe you could, because it's something I've thought about on the opportunity fund front, because we have hundreds of startups in the portfolio. We have pro rata rights sitting out there. It's hard to spin up that many syndicates. Spinning up syndicates just to be like pulling teeth. And so what I was thinking is like an opportunity fund would make it easier for me and for my LPs, right? So now that I don't have to like go bother them every time I have a pro rata. So maybe you could walk me through a little bit of your reasoning for doing the individual SPVs versus just having an opportunity, another $30 million opportunity fund for follow-on checks.
Well, maybe like at the get-go, let's just establish that I do not follow up automatically. Actually, not at all. I turn down most subsequent funding.
Well, yeah, let's assume that these are the top 5 or 10% of your primary funds.
Right. So 35 companies in a fund, 5% of them being really, really good. That ends up with 1 or 2 companies.
Yeah, it's like 1 or 2 companies that are
yeah. So if
that's the strategy. Yeah. Your check size is your strategy, is what, is the common refrain. And we have a small check size with a high volume at Team Ignite. So I can't possibly spin up, because I do 80 to 100 per year now across our 2 active funds. And I just can't possibly go spin up like 5 or 10 SPVs, per year. It's just,
no, I don't think you can. So I think for you, with your strategy, having an opportunity fund makes perfect sense. And I think you are offering a slightly different product to LPs than I'm offering. And I think your product is great, by the way, because you're offering access and diversification. If I invest in you as an LP, and I do have multiple LP positions myself, I know I'm probably not going to lose money with you. But at the same time, I also know that it's less likely that I'll get to 5x or more, right? Compared to a conviction fund.
I was just talking to an LP about this. This will be the episode before you. So if anyone's listening, this is the last episode that I'm referencing, where we had this conversation where I was trying to understand, because I'm a finance guy, right? CFA, worked on Wall Street, all that stuff. And so when I looked at the asset class, I was like, okay, why are foundations like Yale putting so much money into venture? Well, it just returns a lot better than any other asset class.
Returns in any time period that you look at it over the last 30
any 10, 15, 20-year period you look at, venture just outperforms by a long shot. Right. The problem is that there's a high standard deviation of that return, right? And so the asset class itself averages, 25, 30% IRRs, 20%, depending on the stage, sector, geo, all that stuff, and the vintage, right? But generally in the 20s, right? And so if you compound 20% yearly returns in a 10-year fund, you should have an 8 to 10 to 12x fund, depending on the vintage year, stage sector geo. And so what is going on, right, in this asset class where there's just a high standard deviation?
I mean, it's a tough one. But let's put for a second, even though you and I are GPs and LPs, let's actually put the LP lens on. The way I think about it is, let's say if I compare my fund to your fund, which again, my case is more like high conviction, deeper diligence, less checks being cut, higher.
You're checking board seats too?
No, no, I wouldn't be able to. I have 169 portfolio companies.
Yeah.
How would I take board seats and actually be able to do my job?
Right?
Right?
We're about the same now. I have about 165, 6 right now. Yeah, something like that.
So in a way, if I'm an LP and I look at your fund, I'm like, okay, I'm getting almost like an ETF. You're an ETF. ETF of high quality deals, high quality companies. You're going to have winners, no doubt, right? With you, I'm going to very low likelihood of losing money, decent likelihood of making good money, right? Call it a 3x return, but not a very high likelihood of making 5x or more.
But some LPs don't like that. They'd rather, because they're approaching it not like I'm approaching it. So my objective is to not lose investor money. I have a lot of friends and family in my funds. I don't want to lose anybody's money. I want to have a nice fund. That's why I invest in a high volume, what people would call a spray and pray or a high volume approach. But like you said, it caps the upside, but it protects the downside. So there's like, it shortens the standard deviation around the mean, right?
Shortens the standard deviation. So I think if you're a sophisticated LP, you understand what product you're getting. And that's exactly the product I'm getting from you, Brian, is, standard deviation. I'm closer to standard deviation. And that's great if I'm not actively creating a very wide portfolio of people like me. So if you invest in 20 people like me, and I think Shamat actually from the All In podcast he put like his numbers out there. He did like 20 LP fund investments in like, crazy moonshots. And most of these funds basically lost money, but one was a 60x DPI or something, right? And that
you
alone,
averaged 3 or 4x.
Yeah. So I think it really depends on different types of LPs. For family offices, for high net worth individuals, for family and friends, people that want to invest in venture and they don't want to lose money and they want to have a good upside over the S&P 500, I think you offer a great product, right? I think the product that I'm building is more for the institutional LP that's going to make 20 fund investments, and they're going to invest in me because they're like, oh, Itamar could actually do another 10x. I've already done a 10x fund.
Wow,
this is
amazing.
Fund 3. My previous fund is a 10x fund, right?
That's amazing.
So they're like, okay,
that's incredible. People don't know how incredible that is. To just to back up and like celebrate that for a second. That's like puts you in the top like low single digit percentile of funds. You're in the like 90.
My previous fund is my fund 1 is an X and my fund 2 is an X.
Now, when you say that, is that TVPI, like, because not everything's DPI'd out, right?
Net TVPI, and both funds are over 4x DPI.
Amazing. Yeah. So you had no problem raising that 30. I'm sure when you went out to raise that 30 third fund, they're like, how about 100? Why don't you go 100?
So actually, it was really hard to raise this fund, and I'll tell you,
it's been a really tough environment too.
2024, we're just a disaster in LP.
Oh, my first fund took 2.5 years to raise a $5 million fund. That was my first traditional 10-year fund, and it took 2.5 years of kicking, clawing, scratching, cajoling, getting punched in the face thousands of times. Told my baby's ugly. Just, you will fail. I don't understand your thesis. Blah 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 blah. Like thousands and thousands and thousands of times. For 30 months.
I think about this is we've gone through similar things. And the other thing with Recursive, with my funds, is both my previous funds were really, really small, like $1 and $8 million. So they were not this scale of $30 million fund. And I was working at Life360 the whole time. Right. So now is the first time that I'm really devoted just to VC work. And as
you said, you just left Life360 a few months ago, right?
Well, I was an advisor, but technically I was in the payroll. But yes, I was an advisor. I officially started raising this fund in like the second half of 2022, and I've already closed it, but I haven't announced it yet. So yeah, it took me over 2 years to raise this.
Man, so we can commiserate here because that's exactly the time frame in which I raised Seed Fund 1 for Team Ignite. It was that summer of 22 through just now December. We did our final no, seriously, we're finally closing this fund and I cannot accept any more money.
That is great. I'm also oversubscribed, so I'm happy for you as well.
Yeah.
How much did you end up raising?
5. Yeah,
Oh,
it was like a little four, and we raised 5.
that is amazing. Because it really, when you have 5, it really sets you up for the 30 and 40 in the next one if you perform. So
I've already
you're
been told
really
by my fund advisors not to try to go to like 30 or 50. Just do 15 for the next one. Just go 3x what you just raised.
3x is the safe number, but I think okay. So actually, let's get down to what it
Yeah.
means.
Yeah.
This is great for fund manager, but this is also this
Yeah. This is
portion
going to
of
be
the
great for other GPs listening to this because it's like,
GPs,
yeah.
but also founders. So like,
Yeah.
here's the difference because you and I are both doing like pre-seed and seed rounds. I think as long as you're not leading the deal, right, which means like writing $1 million check, probably it sort of doesn't exactly matter if you write $100,000 check, a TK check, or even like a $500,000 check. The difference really happens when you're trying to get the deal from everybody else, like push people out, right, and be the lead, right? Which happens more and more and more with like institutional seed rounds. It
The
happens less.
later stage you get, the more sharp elbows is what you're describing. When I need to write a $5 or $10 million check in the A or B, now there's some little sharp elbows come out a little bit
All
on,
the sharp elbows.
but it becomes more of a zero sum game. Versus you and I, it's all positive. It's like if I invest, it doesn't mean you can't invest, and vice versa. And so this is what people don't realize: pre-seed and seed investors are very friendly, collaborative, and we partner up a lot on deals. It's like, Itamar, like you got to look at this deal, and Brian, you got to look at this deal, and we're just constantly sending these deals back and forth because they're $1, $2, or $3 million rounds, and none of us are taking the whole round. This episode of the Ignite podcast is brought to you by our friends at Build, spelled BYLDD. Build is a development agency that specializes in helping early stage startups, especially non-technical founders and teams, build and launch scalable revenue generating software products. Most startups don't have $100K to hand over to a big agency, and honestly, for your first product, you probably shouldn't. Sure, you could try rolling the dice on some freelancers, but that's a gamble with unclear costs and a lot of project management headaches and no guarantees. That's where Build comes in. For just $10K in about a month, Build can turn your validated idea into a real product that's ready to go to market. It's a smart, efficient way to build a foundation for a company of any size. And yes, companies that start with Build can and have scaled very large. Their clients have gone on to be backed by YC, Y Combinator, and Google, and raise funding at multi-million-dollar valuations. Ready to get started? Head over to build.com. Again, that's BYLDD to connect to Ayush and the team and let him know you heard about Build on the Ignite podcast.
Exactly. So as long as you're in that mode, I say you can maximize your AUM per fund with that strategy. But you're still deploying the same strategy. So whether it's a 100K check or a ticket check on 80 companies, right? Or even have a $500,000 check, you're still writing the same strategy, which means you can grow. You can grow your fund size, you can grow your check sizes within that strategy. When you flip to the lead strategy, that's when you're playing a completely different ball game. It also pushes you into the AUM game and all the things that we talked about before. So that's why I would say if you can go from 5 to 30, that's awesome because at 30 with 50 plus portfolio companies and reserves and blah, blah, right, the follow-ons, all that stuff, you're still not necessarily leading those rounds.
Yeah. Yeah, I love this. This is such a good conversation because you're helping me think through kind of successive fund strategies. You know, what I've been thinking about is like, what is the terminal size of Team Ignite given our current focus? Because you could scale two things. Well, there's a few different levers we're talking about that you could pull on. One is check size, right? Then there's a certain cap to that in the pre-seed and seed.
Unless you switch strategies.
To A, right? Or something. But I'm talking about first checks, pre-series A, early stage.
Yeah.
Call it 500K is where that maxes out without leading and pricing it.
Maybe up to $1,750,000, but yeah, anything over that, you really like
on average 750. Let's call it like 500 to 750, and then so then you have the number of checks you can write. So like for a solo GP, I'm pretty comfortable at about a check a week. So over a 3-year deployment period with some time off, it's 100 to 150 startups. That's exactly what we do in our seed fund. And so for easy math, that's 100. Like I could go deploy $100 million fund that way.
Yep.
Roughly.
You can.
With first checks.
And that's with one GP.
Just me.
GP.
Yeah.
And that's how you get to.
And I'll have assistance by then because I have 100 million.
For a 4 model, right?
Yeah.
When you look at those are pre-seed funds, right? A 4 especially. They're saying we're a pre-seed fund. And they have several modes, and obviously they can write a $2 million check, and they can. I think their last fund was $180 million on 2 or 3 GPs focused on pre-seed.
Who is this?
A 4 Capital.
A 4. I haven't met those guys.
they're the biggest pre-seed fund in the valley.
I got to meet him. Well, I'll take an intro after the call.
Yeah, I'm love to introduce you to
Or
them.
somebody
I'm part
listening
of
to the show,
their,
look him up.
there's a network of smaller funds that they work with, and I'm one of the founding
Oh, nice.
members.
Okay. All right. So you got the check size, and then you got the volume of deals, so over typically a 3 or 4 year deployment period, right? Some people do 2, some people do 5, but I think 3 is kind of the sweet spot. And then you have the follow-on strategy. Yeah, talk us through that. So you can go write a bunch of, let's just, for easy math, I just wrote $100 million first checks. So I deployed 100 million, and now I got, pretty good pro rata rights, maybe even some super pro rata rights for a bunch of 10 cap, 20 cap companies that are now raising their A at a 20, 40, $60 million valuation. So I have millions of dollars sitting out there, the top 5 or 10%. Yeah. How would you think about that?
First of all, let's establish what the data says. The data says that your first check is always by far your best check.
Right.
The data also says
highest risk, highest return.
Yes.
Yeah.
The data also indicates that VCs often fall into the trap of having good money follow bad money.
Tell us about that. What does that mean?
Well, it goes back to what we talked about a little bit with VC partnerships and saving face, right? Oh, we did this initial investment in this company, and maybe as a partner in your heart that it's not working as well, but you are under a lot of pressure to build a successful portfolio. And obviously, when a company runs out of money, the music stops no matter what, no matter how good they are, no matter how great of a technology they've built, it's done, right? So, in a way, especially in those bigger venture funds, you are incentivized almost to follow on and bridge your portfolio companies, even though you might know deep in your heart that it's done and you should move on.
This is a really interesting psychological mechanism. This is, you might call it the foot in the door effect or a sunk cost bias, right? Where I've written the first $1 or $2 or $5 million check. I'm sitting on the board. I have a vested interest in saving face here. I'm invested. And now the founder comes to you, a 2x revenue, which isn't that good at the early stage. And they're like, hey, we're running out of money and we're going to do a top off round, right? A bridge. We're not quite ready for A. We just doubled revenue for, call it $1 million to $2 million. We've seen this in our portfolios, right? And now they're opening a bridge for 500, $1 million, and they're saying, okay, we're going to go burn that and get to the Series A territory.
Yep.
And that's the good money after bad. That's the dead zone right there. That's where you should not follow on.
And again, we have data indicating, although this is not as clear of a cut, but it's out there, that that's one significant way that VCs lose money. So now let's apply that to you and or other GPs out there managing smaller funds. I think what that means is, especially the pre-seed stage where there's a lot of bridging going on because it takes time to take off the ground, and like most companies, unfortunately, don't make it, is that my philosophical belief is that you should have very little, if any, reserves in these type of funds. And you should treat any follow-on as using the same standard that you would treat the initial investments. So writing the full diligence, in my case, writing the full memo, really justifying just this new tranche of capital you're putting in, regardless of whatever capital you already have in this.
Imagine you're coming in blind. You almost need to, almost like if you have a big firm, turn it over to your Series A partner and say, you evaluated, it's a different, almost like a different fund would be another way to do it. So you're almost arguing in a way that you should have a different fund to do your follow-ons.
That's sort of what I'm doing because my reserves are really, really low. And then I do the follow-ons with syndicates. So the syndicates is almost like a new fund being formed. I do have some capital for reserves. And I actually when I started this fund, I was allocating more to reserves. And over time, my allocation went down and down and down and down and down. And this is a very unpopular thing to say, but I'm going to put it out there because I'm a straight shooter. I don't like tricking.
I love that about you. Yeah.
I tell my founders that they shouldn't automatically count on me for bridges and follow-on funding. Even if I have pro rata, I'm like, yes, I'm asking for the pro rata, but it doesn't mean that I'll do it. I got to be honest with you. If you're going to perform, I'm going to be jumping in with blazing guns, preempting this round with a $5 million syndicate, and I've done that before. And I'm going to be all over this in a good way. But if you're not performing, if you're looking for a VC that would automatically invest in your bridge, then I'm not that guy. And yeah, sometimes founders tell me, okay, that's what we're looking for. And I'm like, okay, I'm not a good fit. That's great, right?
So let's talk about when you should follow on and when you shouldn't follow on. Like, what are let's imagine you wrote that $1 or $2 million check. And now it's a priced round. Let's call it a seed or an A. What kind of metrics are you looking at where you're like, yes, this is definitely taking off. I should lean in here. I mean, you already decided, like, you like the idea, you like the team. I mean, you already invested, right? And so now it's like, do I follow on?
Right. So look, there's no one rule of thumb here because every industry is different and traction is different in different industries. Like you take something like cybersecurity, which I've done a few over the years, and like, a company with 100K of ARR, but significant technical validation and interest could get a $20 million raise going, right? Like it's crazy because it's cybersecurity. And then you look at something like SaaS, which is kind of out of favor today, unless it's got a big AI flavor to it. And you could be looking at, a company with $1 million of ARR coming up for an institutional seed round, and nobody gives an F because it's just $1 million of ARR, right? So it really varies a lot by vertical. You have to know your verticals. You got to know what the post goals are for that vertical. But I think what I'm looking for more than anything else is very clear customer validation that this is a scalable solution that they're going to pay for, that others are going to pay for, and that has a significant impact and engagement for them as a customer. I think it's more about that than about the numbers because my follow
Well, don't
on.
you do what kind of? I mean, you have to quantify it somehow. Like, what is the customer validation numerically that you're looking for? Is it net revenue retention? Is it logo retention?
Oh,
Is
we're
it kind?
not. We are not even close. I mean, we're talking about transitioning from pre-seed to seed. So it's really conversion rate on design partners, right? We signed up 10 design partners. Are they like, okay, 18 months later, are they paying? Are they in
Right.
production? Right?
Yeah.
That's an obvious one. And I'm also looking, unless you change your ICP, I'm also looking for an acceleration in the pipeline.
Mm.
This is B2B companies, obviously. I'm like, okay, you're doing a demo and it took you 3 months to get a procurement. Now you're doing a demo, it takes you a month. Interesting, right? Clearly the message is resonating better and it's getting faster to contract.
That pipeline conversion cycle is getting better.
Yeah, velocity on the
Velocity
pipeline,
of the pipeline.
momentum.
Yeah. Yeah.
So I look for that. That's another obvious indication. That's more in the enterprise companies. With consumer companies, because I also do consumer. By the way, I built both consumer and enterprise companies.
Right. Yeah. I mean, Life360. You know it really well.
Life360 is pure consumer, and Gigia, which got sold to SAP for $250 million, I was head of product, was a pioneer developer platform SaaS company. So completely different, right? And I'm an engineering background, so I can do both. But with consumer companies, obviously you look at main consumer KPIs around lifecycle engagement, retention, increasing downloads or unique visitors, and so on and so forth. And I think what I'm mostly looking for there is obviously you want to see the velocity and things going up and to the right, but I want to understand it more from, is there like a word of mouth sort of virality or a really, really successful repeatable customer acquisition strategy here,
Mm.
right? And so it's
Some sort of
more,
viral coefficient in the consumer model. Like, does every person that comes on to Life360 bring more than one other person?
or even like with Life360, one of our early stories is we really nailed ASO, App Store Optimization. And after I was able to succinctly show that to investors, like, okay, we get it. Like you have a plan. Like this is working. And it did. So something like that where I can tangibly
There's some
say,
sort of sustainable distribution advantage inherent in the model.
right, because I don't think
Yeah.
it's,
Or compounding advantage.
yeah, because like with the exception of a few very specific categories in consumer, you're not going to grow into a big company just with paid acquisition. You got to have some sort of a word of mouth or SEO or some angle that's organic.
Yeah. People have to talk about it. Like, I talk about my tonal workout machine all the time. My wife just like rolls her eyes, like, stop talking about your tonal. But I love it. It's so amazing. It's such a cool machine. I just tell everybody about it. But sometimes it is just about building a really amazing product where it is a better mousetrap and people will beat a path to your door.
And by the way, I'm very bullish on AI in consumer now. I think we've had like a decade plus of, it was always impossible to build a significant consumer company, and now with AI, I think we're going to rewrite human machine interaction, which I'm very excited about. So I'm going to do even more consumer in this fund.
Really? Okay, that's interesting. And I want to pull on that thread, but first I want to go back to something you said, which is SaaS is out of favor. Tell us more about that.
I don't think SaaS is bad. SaaS is great. I made a lot of money in SaaS, and I'm not the only one. Clearly, that was the kind of the jewel of the previous cycle. But in a way, it's been eclipsed by a more sexy sibling called AI, right?
Right. which has a little
So,
bit more usage based instead of like seat based or company based pricing models.
well, when I said SaaS, I didn't necessarily mean just the business model or pricing model. I was more thinking about this. What we typically think about as SaaS is software delivered on a subscription basis, probably over the cloud, right? And sort of mostly building either vertical or horizontal solutions that capture certain workflows that enterprise customers want and need,
Right.
right? That's what I think that
That's a good
previous.
summary of a SaaS. I think you nailed it.
Yeah, well, I've got a lot of SaaS investments as well. Practice it myself, but I think the thing that's interesting there is that a lot of people are getting now like to the point of like understanding that AI can really be very disruptive for those SaaS companies because in SaaS, what you're really trying to do is you're putting in all those rules and heuristics so that you create a use case or a workflow for your customer. And sort of we're getting to a point with AI where the AI can figure all that stuff out instead of having to write it in, deterministic software and having it kind of rigid. And so AI can do that. That's
Yeah.
one.
Well, SaaS
And two,
is there's a metamorphosis happening, right? It's almost like the butterflies coming out of the shell with AI. And now you're getting almost what I like to call AI eating software and generating more software, creating software in lots of niches, nooks and crannies that previously just wasn't monetizable or didn't make business sense. And that's why we're more bullish on the vertical SaaS. And it's kind of like I built a lot of AI, and why I didn't do an AI fund because I know AI is like hard to make money at, especially at the foundational model layer. Could have done an AI fund. Team Ignite could be like the Bell AI VC firm or whatever. But I knew it wasn't going to be. It wasn't
yeah,
going to be a good like thesis because AI is so hard to make money deep in the stack, but it's really, really amazing up in the stack at the platform and
the
application layer.
application, which is, by the
Yeah,
way, exactly what we're focused on. Recursive Ventures 3 is an AI and data focused fund investing in companies in the application layer. We don't invest in the stack. We don't invest in infrastructure. We don't invest in LLMs. My thesis all along for this fund was LLMs are going to be a commodity and the money is going to be made in the last mile at the application layer. They're taking those models and really fine tuning them for what customers need to get stuff done.
100%.
So
It's always been the last mile for AI. Like you have these super powerful generalized platforms and models, and then it just boils down to like, okay, what is the very narrow use case that I can go really super deep on to deliver a ton of value?
that's right. So I think I'm going back to why SaaS is out of favor. First of all, yes, AI is disruptive to SaaS. And B, AI creates all those new opportunities, significant opportunities that kind of take SaaS to the next level where without that, SaaS doesn't work as well. Perfect example, and we're doing a lot in that area is this more recent trend, and everybody's doing it. I've been calling it out for 2 years, but now everybody's doing it. Services as software, right? Which is conceptually taking a services business, which VCs would not have touched 2 years ago because it's a low margin business. VC is all about high margin, where the marginal cost of servicing one more user trends to zero. That's the magic of software. That's the magic of venture capital. But now you can take a services business like an accounting firm, and let's not talk about bench because that's a whole different story, but like you can take an accounting firm and basically potentially get it to an 80% terminal operating margin, right?
Yeah.
And that makes it a good
Now every
investment.
customer in that accounting do, and we have quite a few vertical SaaS companies like this in the portfolio that are basically using AI to reinvent services. I mean, I call them SaaS businesses, but basically it's AI accelerating the labor to a degree. And I love how you framed it. It's now the labor of servicing these customers approaches zero on the margin.
That's right.
That's
So,
really incredible. It's a
so
real
conceptually,
incredible transformation of AI eating the world, right?
eating the world and eating services, and Sequoia framed this as a multi-trillion dollar industry, but it's also if you do it right, it's very interesting because instead of having to go to a customer and say, hey, install this software and train your employees on this and like change your workflows, now you're telling the customer, no, you don't need to change anything. I'm going to give you the same service with the same quality you're used to at half the price, and I'm going to make a lot of money because internally in the backend as a vendor, I'm automating all those things, and you don't
Mm,
even care about that.
yeah.
You're going to get the same quality of service, and I think that also presents an opportunity for very, very fast growth companies like we've never seen before. I'm excited about that.
Well, yeah, it's like kind of the best time to be an investor ever. It's just like every generation gets, like, I'm such a techno optimist, but like it feels like Technology just makes everything better every 10 years, like an order of magnitude better. And being an early stage VC, there's never been a better time to invest in these early stage companies,
Yeah.
like in the history of investing. Because now I'd hate to be like a mid or late stage investor, because now these new crop of companies post large language models need fewer and fewer amounts of capital per unit of like revenue output. And so you're getting, I see companies all the time getting to 1 or 2 million of ARR bootstrapped.
Bootstrap.
Just
Exactly. And by
bootstrapped.
the way, they might not even ever raise a growth rate.
Yeah,
Say,
I got somebody, I got a firm. It's AI for accountants. I should send it to you.
yeah.
Really cool firm. And they're like, I think we might cut the round down a little bit. I don't think we need that much money. I think we're raising too much money, you know?
Can you
That's
believe
pretty
that?
crazy. Said
What
no
is the
startup
pre-seed and
ever.
VC going to do with their $7 billion funds when these founders are just going to come up and say, I don't need those VCs because I'm already profitable. I'm making all this money. I'm growing fast. And, like a core group of 10 to 20 really amazing data scientists and researchers are solving the problem. I don't need
A-
to hire
yeah,
50.
like there's the what you might call the AI enabled organization, or what Sam Altman's, his betting group is betting when's the first solo unicorn founder. But I think that's probably already been started, most likely. And I think before that, you're going to see the first 10-person unicorns. I mean, you had Instagram, famously got bought for $1 billion with 13 employees. I shared an office with them actually in San Francisco. So I remember thinking like, that's weird. But I think in the future, you might see these pretty big enterprise companies with just basically executive teams and
Yeah.
AI all beneath them.
Yeah. Yeah. Spot on. So what does that mean for venture? And I think, honestly, that's music to my ears. And I think it should be music to yours because we're the ones writing checks that help people like leave their cushy job at Google to start this company. And for some of them, that's going to be the only check that they'll ever need.
Right. And
How
so you
crazy
could
is
almost argue like we might be the mid-stage investors someday. And there might be like venture incubators, venture studios, accelerators that are like, oof, I'd hate to be a pre-seed seed investor right now. And we'll have to go even earlier. We'll have to be like pulling people out of their corporate jobs with seed checks or whatever. So you've invested in a ton of unicorns. What are some common patterns? I guess this is backwards looking. And how do you feel like those patterns might be changing, given our kind of
that?
future facing conversation right now? Yeah.
When somebody walks up to me and says, Hey, Itamar, what's the pattern recognition that leads to success? I'm like, there isn't any. Success is unique. Every success story has its own unique flavors.
Ooh, I
And
love
if you
this.
try to repeat it in your universe, in your world, and what you're trying, you're unlikely to be successful.
This is exactly what I tell my LPs when they're like, "Hey, how do you pick startups?" I'm like, "Well, every startup's a beautiful snowflake. I look at the unique crystalline structure of that startup and that founder, and I try to figure it out. But the breakouts are unique. They're
The breaks
unique
are
somehow.
unique.
Yeah,
And so here's the thing.
I love that.
Instead, I flipped it on its head. And I focus on because we don't have data. We don't know what are the things that lead to success, but we actually have a lot of data and we know well what are the things that end up causing failure and companies shutting down. So I've created a content series that focuses on anti-patterns, and I've really I've kind of jotted down 74, and these are all
74.
74
Wow.
anti-patterns in startups. And those are patterns. They're not necessarily going to kill your company tomorrow morning. They
Yeah.
could. They could.
I mean, if you have all 74, probably.
Well, you don't even go that far. They could just have 10 and that already
We could
kills
probably get a data science to crunch these anti-patterns and kind of do a predictive model based on how many of these and what's the weight. A logistical regression sort of predictive model or something.
That's a really interesting idea. I might take you up on that
Yeah.
one day and kind of do that idea. But basically, what I'm saying is, if you practice those anti patterns, which but inherent anti patterns is actually a computer science concept of like doing something that makes a lot of sense at the time, but actually it has a very bad negative mid and long term impact.
Mm.
Right? That's what a startup anti pattern means. What happens is if you start like practicing those anti patterns and you have them in your company, it's death by 1,000 cuts. Eventually, your company is going to go right. Sometimes faster, sometimes slower. But basically, what I'm saying is, I think the best way, especially for folks like you and me, who are doing a lot of smaller checks at the earlier stage, we don't really know who the winner is going to be. Like anybody at the stage that we invested that's going to tell you, I know how to like pick winners. is bullshitting you, or they're
Mhm.
lying to themselves. It's not true. We don't know who's going to be.
No,
What we do know is who's doing stupid stuff that's probably not going to work, right? So the pattern recognition is actually a failure, not a success.
I love that. I love that. Yeah, I mean, it's a nice way of framing it, and it crystallizes sort of my easy yes, easy no framework. Because you see stuff and it's like, that's an easy no. I've seen that before, and it has some sort of yellow, red flag or some combination of those that I just don't think it's going to work.
It's about
And the
the
hard part is getting down to that last like 5, 3, 2%, that top 5% and saying yes to like one.
exactly. And also for the founders running the companies, again, I'd recommend reading itamarnovick.com. That's my blog. We talk about the anti-primes. I go into some of them in depth and like, here's how you can really diagnose these. Here's how you get them out of the system. Here are the benefits, right? I think it's also a great way to run a company. And like, okay, we have to figure out our way to success with experimentation, with this and that. We don't know what the right path forward is to success, but what we're here for is we're here to figure that out. But team, here are the things that we absolutely shouldn't do because we know they don't work, right? So we can skip those and move on to the fun, good experimentations that are actually going to get us off.
Yeah, I love that.
So yeah, but I've been fortunate. I've 7, soon to be 8 unicorns in my portfolio, all pre-seed, all very early. 2 are decacorns. Deal obviously is a big decacorn of mine, and Sentinel One, which I did when I was at Upwest with the team there. That IPO'd for $9.5 million. Then another 5 unicorns. Went through 3 IPOs. One of them I ran myself, the Life360 one. I was the CFO, took it public. It was way harder than I thought it would be. If somebody comes to me again and says, "Hey, you want to IPO my company?" My answer is going to be, like, absolutely not. Like, I'm not doing
And why is that?
well, it almost got me divorced. It's fundraising and steroids for 2 years, and then cleaning up everything, and then like pitching and road shows.
So you're just gone like all the time on the road, doing the roadshow thing.
Yeah, it's hardcore. So yeah, so I had 3 IPOs in the portfolio, another 20 M&As, give or take, for the last 15 years. So some more successful, some less successful, but
right.
hey, we found good homes.
Some singles
these.
and doubles in there.
And I think that's what it takes, actually. I mean, Brian, you've been doing this for a while as well. I think it takes 10 years to train a GP. Like, you have to see the entire cycles go for again.
Oh yeah, there's a famous phrase like it takes 10 million to make a GP, something like that. You have to lose 10 million or something, I think is how it goes. But I could definitely see that. I've been investing for 7 years, 5 with other people's money, 3 with funds, and you definitely learn a lot. You take some lumps. And yeah, I mean, I think you got to get to, I think the number is 100 investments. I think there's some truth to, like, that's the old adage in real estate. Go look at 100 deals before you invest in one. And I think in startups, it's similar. By the time I made 100 investments, I probably looked at tens of thousands or 10,000. But those 100 investments those first 100 taught me so much.
Exactly. Obviously, your learning curve flattens over time. I'm not saying
there's an asymptote. Yeah, for sure.
Bet without actually playing the game. You should. But I think that's something that was lost on many people in the last cycle of like, oh, I'll just raise a VC fund and it's going to be okay. It's like, no, it's not going to be okay. It takes a lot of time to learn how to do this job well. And you're playing with other people's money and their pensions and their kids, tuition to call, like all that stuff. It's like you have to take your fiduciary duties as a fund manager very, very seriously. And unless you have conviction that you know what you're doing, it's, at least for me, it's a harder call to say, I'll just take this money and run with it. Like, yeah. But this
the pressure definitely goes up in order of magnitude when you start investing from a fund versus running a syndicate. Because originally I was a syndicate for 2 years, and that's everybody's making a decision to invest in that syndicate. It's not me making the decision, so it's a little bit different pressure.
Very different. Kind of that difference between syndicates and blind pool is massive. I think you're right. So I have a lot of folks coming to me saying, "Hey, I was running syndicates. Should I run a fund?" It's like, yes, if you want to, but here's all the caveats. Right? Like,
you know what's actually really fun for me, and I should create a slide in one of my pitch decks on this, is it's the syndicate anti-portfolio. It's the ones that I wanted to do that weren't able to close with the LPs and Team Ignite. And there's quite a few, and which is why I like the opportunity fund model better than the syndicate model, because syndicate model, I have to go like convince LPs to invest. versus like, I feel like I know probably better than my LPs in a lot of cases because I'm doing this full time and thinking about it all.
Hopefully, if they give you the money.
Right. And so like the syndicate model is ultimately flawed because people will invest in kind of, it has some shiny object to it, right? But it's not really a great investment.
You know what we really need? We need something in between, because the syndicates have the problem that, rightfully so, it's true. You're describing of like, okay, I need to like hold this deal on both sides, like raise the capital, and I can't promise to the entrepreneur that we're going to have this much and that. Like, it's really hard to do those syndicates, and they're not really efficient. And the flip side, if you know what I said previously about the opportunity funds, is they force you to put money into companies even if you shouldn't, right? That's kind of the negative. So we almost need something in between, where there's like a dedicated pool of capital that you can, but you don't have to pull. Let's say you're not getting management fees on it, because that's the whole
That's
point.
how I would view an opportunity fund is I'm only going to call it when I feel like I have a great opportunity. And so the deployment period might be 3 to 5 years, depending on the opportunities. Not, I'm going to definitely pull it. I'm only going to pull it when I have a definite opportunity. So I think, you know,
And you might not have, but that's a difference. For a fund, has a number attached to it.
yeah,
Filings. It's like, okay, I have a $50 million
I
opportunity
got to
fund,
go deploy this over the next 3 to
4-year
4 years. Yeah.
investment period.
Yeah.
That's a fund. And how you're thinking about it, it's almost like it's not a fund. It's a blind pool that's sitting there on an opportunistic basis that might or might not get deployed. And if you do that way, I think it's brilliant, because then you don't have to deploy. You're deploying only because it's a great offer.
It's basically like my own personal syndicate money. It's like I will pull it when I decide, not when you decide to invest. Yeah. Anyway. Yeah. But I need to create that. There's the missed opportunity slide where we couldn't get the syndicate put together on the second check. Let's call it the pro rata check. And then there's the missed syndicate slide, right? We could have done a really good first check here, and I couldn't get the syndicate put together for whatever rhyme or reason.
Yeah,
we ran out of time.
Anti-portfolio, but this is a more classic form of anti-portfolio, because it's not that you made the wrong, quote unquote, in hindsight, it's easy, investment decision. You actually knew that you had to invest, but your hands were tied.
Yeah, my hands were tied from the syndicate. Let's really quick just cover your anti-patterns. I know we can't cover 74, but maybe there's a few favorites that you like to talk about.
Well, I mean, bad revenue is a classic one, right? Where you're potentially hiring, you're closing the kind of wrong, customers, and they end up sucking the life out of your company, and you should have fired them, right? So that's a classic one with enterprise software. Another one that I'm giving in the article there, I'm actually giving examples of myself doing it, is called elephant hunting. So it's kind of trying to pin down an elephant, a big corporate, enterprise customer. Takes a lot of effort, a lot of time, long sales cycles. You end up putting all your chips behind that elephant hunting bet, and then you're left with nothing, versus going after small, nimbler customers who could potentially have bought your software by the time that happens.
I see that with partnerships too. You go after this big partner. It's a big logo, big, $10 billion company. We're going to partner, and they're going to help us distribute into their customer base and blah, blah, blah. So you spend a bunch of time and money integrating.
Not an anti-pattern, but it should be. Because one of the biggest mistakes that I see founders do, and they also pitch us that as for us in our investment roles, is they talk about all those distribution channels and partnerships, and man, it almost never works well for startups. It's like, it's not a good fit. Most of the time, you need to go direct and actually have a conversation with your customers to develop the best product and win in the market. And relying on those big corporates to distribute your product almost always gets messier and harder than you want it to be. So I'd actually venture all the way to say that BD is bad in most early stage companies. You shouldn't have BD until you're like much later.
Let's close with some quick rapid fire questions, if that works.
Yeah, sure. Let's do it.
What's a misconception about seed investing you wish more founders understood?
I guess a lot of founders expect VCs at the seed stage to really understand their business. And the reality is most seed investors are more like generalists. So they don't. And it's on you as a founder to kind of help educate us.
Which industry is most ripe for disruption through AI in the coming year or two?
Well, I'm really bullish on antiquated industries, financial services, insurance, real estate, specifically with AI. I think AI is going to make a huge dent in those industries.
What's a startup you wish you had invested in but didn't?
Oh, wow. There's so many in my anti portfolio. Just pick a random one. Waze.
Oh, wow. That sucks. What's the most underrated skill for founders to develop?
Grit, but I don't know how you develop it.
Yeah, you either have it or don't you? Yeah, that's interesting. Your favorite entrepreneurial book or resource?
Um, I don't really have one, so I'll pass on this one.
I like that. Your blog, right?
Yeah, come read my blog.
Yeah. How do you unwind after a long day?
YouTube Shorts.
Yeah,
My
nice,
kids drag me into it. It's horrendous.
nice. Yep.
But
Who has influenced your investing style the most?
probably my GPs at Morgenthaler Ventures where I work, people like Mark Goins and Gary Morgenthaler. They're sort of old school VCs, but they've learned through practicing venture capital for 40 years.
Yeah. What's a common mistake you see founders make when pitching?
Some of them, and this is a bit controversial, some of them don't go to the deck. And I think for the first pitch, you should go to the deck because what the deck
I agree.
does,
Just go to the deck.
go
Is
to
it
the
okay if I walk you through the deck? That's what you should ask.
walk me through the deck, and I'll tell you why. Because what's hard about pitching is making sure that you communicate all the key points that you really have to communicate, and you've done a good job doing that. And VCs easily would drag you into a random Q&A and like all those different questions and what they think is
100%
right,
agree.
what they think is wrong. And no, you as a founder, you got to make sure that you spend the first 20 minutes after the intros, just communicate check all the checkboxes that you have to check before you open it up for a conversation.
I love that. I 100% agree. I tell founders, I tell them, like, we're going to do intros. You're going to walk me through the deck and we'll do a demo if there's time. That's the agenda. I just tell them that. But yeah, I think that's a big mistake. Hey, can we just have a conversation? No, we're not going to have a conversation. Walk me through the deck. We're not friends yet. What's one piece of tech you can't live without?
Slack, probably at this point. Like I have so many groups. I have all my founders in there. That's just an easy way.
That's cool. Describe Recursive Ventures in 3 words.
My first adventure, best AI pre-seed fund in Silicon Valley.
That's more than 3 words.
I know, but it's impossible to.
I love it. World's leading pre-seed fund. I don't know. Well, that's interesting. We have similar goals, and that's great. It was a great conversation. Where can folks find you online?
Well, obviously on LinkedIn, I post daily. X, Twitter, kind of almost the same. But to be completely honest, I don't really do cold calls. If you want to have a conversation with me, get an
intro. Ask me for an intro, and I will be your screener. Thanks so much for coming on. Really enjoyed it.
Thanks, man. Had a blast. Appreciate you having me.